What if I told you that in 2026, you could legally keep thousands more of your own money without hiding income, without risky loopholes, and without getting in trouble with the IRS? The truth is, most Americans overpay in taxes, not because they earn too much, but because they don't plan smartly. And today, I'm going to show you exactly how to legally pay less taxes in 2026 using strategies that business owners, high income professionals, and financially savvy families already use. Before we begin, quick disclaimer. This video is for educational purposes only and not personal tax advice. Always consult a licensed CPA or tax professional for your specific situation. Now, let's get into it. First, understand this. The U.S. tax system is built on incentives. The government rewards behaviors it wants to encourage, like investing, owning a business, buying real estate, saving for retirement, and providing health coverage. If you align your financial strategy with these incentives, you naturally lower your tax bill. Strategy number 1, max out tax advantage retirement accounts. In 2026, retirement accounts remain one of the most powerful tax shields. If you're employed, contribute aggressively to your 401k. Traditional 401k contributions reduce your taxable income dollar for dollar. For example, if you earn $120,000 and contribute $23,000, you're taxed as if you made $97,000. That alone could save thousands depending on your tax bracket. If you're self-employed, a solo 401k or SEP IRA can allow even larger contributions, sometimes over $60,000 depending on income. Think of it like moving money from a taxed bucket into a protected vault. Second strategy, use health savings accounts or HSAs. An HSA is triple tax advantaged. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. It's one of the most powerful but underused tax tools in America. If you're on a high deductible health plan, you can contribute thousands annually. Over 10 to 20 years, this can become a massive tax-free medical fund. Third strategy, leverage business deductions, even if you're not a full-time entrepreneur. Many Americans are starting side businesses, freelancing, consulting, content creation, or e-commerce. When structured properly, legitimate business expenses reduce taxable income. Home office deductions, internet costs, software subscriptions, mileage, equipment, education related to your business. These are not loopholes. They are legal deductions written into tax law. The key is documentation and legitimacy. If you're earning side income but not tracking expenses, you're voluntarily overpaying taxes. Fourth strategy, optimize capital gains and investment income. Long-term capital gains are taxed at lower rates than ordinary income. That means holding investments for over a year can significantly reduce taxes. Additionally, tax loss harvesting, strategically selling losing investments to offset gains, can reduce your taxable capital gains. High-income investors often use this to control their effective tax rate. Think of it like using losses as a coupon against profits. Fifth strategy, take advantage of tax credits, not just deductions. Credits reduce your tax bill dollar for dollar. Examples include child tax credits, education credits like the American Opportunity Credit, energy-efficient home improvement credits, and EV tax credits. A $2,000 credit is not the same as a $2,000 deduction. It's far more powerful. Always check what credits apply to your situation in 2026. Sixth strategy, consider entity structure if you're self-employed. Operating as an S corporation instead of a sole proprietor may reduce self-employment taxes if structured properly. This is not for everyone, but for profitable small business owners, it can save thousands annually. However, this requires proper payroll setup and compliance, so professional guidance is critical. Seventh strategy, real estate tax advantages. Rental property owners benefit from depreciation, mortgage interest deductions, and 1031 exchanges. Depreciation allows you to deduct the cost of the property over time, even if the property is increasing in value. That's one of the most powerful wealth-building tax tools in America. Real estate investors often pay surprisingly low effective tax rates because of this. Eighth strategy, timing your income strategically. If you're close to a tax bracket threshold, deferring income into the next year or accelerating deductions into the current year can legally reduce taxes. Business owners often use this at year-end to optimize liability. Now here's the key mindset shift. Tax planning is proactive, not reactive. Most people